Gold survives chaos. Bitcoin survives debasement. These are two different problems. Most retail investors mix them up. They think gold and Bitcoin compete for the same role in a portfolio. They don't. They hedge different threats on different timescales with different drawdown profiles. The investor who treats them as substitutes underweights one or the other based on whichever has performed better recently. I'm Rachel from ChainSense. In the next 5 minutes, threats before tickers, drawdown shape before the drawdown, and allocation before allegiance. Start with what each asset actually protects against. Gold has 5,000 years of crisis asset history. War, currency collapse, regime change, banking panic. Gold has been the asset of last resort across cultures, languages, and political systems. The reason isn't gold's industrial utility. It's that gold cannot be printed by a central bank, cannot be defaulted on by a government, and is recognized as a store of value almost everywhere on Earth. Gold's value comes from continuity. Clip break. Bitcoin has 17 years of history. Most of it has been about something different. Protection against monetary debasement. 21 million coins, fixed supply, less than 1% annual issuance, and decreasing through halvings. Since the 2024 halving, Bitcoin's supply growth rate is now below gold's. The supply schedule is mathematically locked. No central bank, no government, no popular vote can change it. Bitcoin doesn't survive war the way gold does. Exchanges fail. Internet access matters. Key custody requires infrastructure. Bitcoin survives a different threat, slow fiat erosion across decades. The question isn't which is better, it's which threat you're hedging. The two assets behave nothing alike during stress. Gold drawdowns are historically 30 to 40% over years, not weeks. The metal stays liquid in normal markets and stays liquid in crisis. Central banks, sovereign wealth funds, and gold ETFs absorb supply at predictable bid-ask spreads. Bitcoin drawdowns historically run 70 to 85% over weeks. The post-ETF period has compressed this to roughly 30 to 50%, but Bitcoin's volatility profile is fundamentally different. Liquidity exists, but bid-ask spreads widen sharply during stress. Clip break. This volatility difference matters more than retail investors recognize. Gold sits in a portfolio for years, and you barely notice it. The price moves slowly. Drawdowns happen on multi-year timescales. The asset tests your patience, your willingness to hold something dull while other things rally. Bitcoin demands attention every quarter. The price moves daily by amounts, gold moves over months. Drawdowns happen on multi-week timescales. The asset tests your nerve, your willingness to watch a 60% drawdown without selling. Different stress responses required. Gold tests your patience. Bitcoin tests your nerve. The right answer for most portfolios is not gold or Bitcoin. It's gold and Bitcoin, in different sizes for different reasons. Gold serves as your portfolio's crisis asset. 5 to 10% allocation, held physically or in regulated ETFs, sized for the worst-case scenario you can't predict. This isn't a return-generating allocation. It's an insurance allocation. Bitcoin serves as your portfolio's debasement hedge, 1 to 5% for conservative investors, more for those with longer horizons and higher volatility tolerance. Different objective, different sizing, different rebalancing rhythm. Clip break. 3 considerations make the mixed allocation work. First, the correlation between gold and Bitcoin is historically low to mildly positive. Some periods see them moving together, usually when both are pricing in real rate compression. Most periods see them decoupled, gold responding to crisis flow, Bitcoin responding to liquidity flow. They aren't interchangeable hedges. Second, rebalancing horizons differ. Gold gets rebalanced annually, if at all. Bitcoin's volatility means quarterly rebalancing is more honest about position drift. Third, the assets compete for portfolio room only if you treat them as substitutes. Treat them as different tools, and they cohabit naturally. Gold isn't Bitcoin. They protect different things. 3 things. Gold protects against chaos, physical world disruption that lasts years. Bitcoin protects against debasement, slow-burn fiat erosion across decades. They are not substitutes. They are different tools for different threats. The right answer is most often a mixed allocation. Gold isn't Bitcoin. They protect different things. The full Bitcoin investing framework is in the Hub video, link in the description below. Subscribe to ChainSense. I'm Rachel. See you in the next one.